Today's guest is David Dredge. Some of you may have noticed that this is the second time we've had Dave on. He was a recent guest on the October 22nd episode. And if you haven't already, I suggest that you listen to that episode. Dave has over 30 years of experience managing risk across global markets. He's the founder and CIO of Convex Strategies, which is based in Singapore, and he's in Singapore today. Previously, he had built and run emerging markets trading at Fortress, RBS, Bankers Trust, and Bank of America. Dave, welcome back.
Thanks for having me back, Alex.
I have to tell you, I re-listened to our episode several times and thought that you shared a highly insightful framework for thinking about risk. And a few counterintuitive concepts stood out to me, at least. Risk is not what you're anticipating. It's what you're not anticipating. Another is forecasting is foolish. Another one is insurance gets cheaper the more valuable it is. And then the other one that I thought stood out is you can invest more aggressively when you are properly hedged. So I'd like to delve into some of these a little bit further and ask a few additional questions that have come up since our last conversation, if that's okay with you.
It's great. I hope I have something more to say. We'll see.
Well, we'll see shortly. So in our last conversation, you made many logical assertions about risk. When I listened to it, it all makes perfect sense. So given that, one of the main questions that I've heard is, if it's so obvious and there's many smart investors in this market and that play this game, why are these simple, obvious concepts so easily missed by so many?
That's a big question, to be honest. And it's sort of the thing that leaves me scratching my head and sort of continuing to fight my battle years and decades on. I guess sort of bluntly put, incentive structures. So the financial industry, the financial fiduciary industry has grown up in the realm of what I call sharp world, the sort of consensus mathematics of efficient market hypothesis and modern portfolio theory and capital asset pricing model and random walks and Gaussian distributions and all that nonsense, if I may say, and has structured around itself a methodology and incentive structure that operates within that. And going back to I'm sure I used the race car example in our last conversation, in that 40 lap race through unknown straightaways and curves, lap after lap, we agreed that the guy who wins is the guy with the best brakes, because he's the least likely to crash and he can drive the fastest. So he's got what we call convexity. He's got acceleration and deceleration. So he can operate most safely and aggressively in the unknown future curves. And his objective is separation lap after lap after lap and terminal standings at the end of 40 laps. But in the world of financial fiduciaries, the incentive structure, as it's been formatted around the sharp world methodologies and regulations, tends to be one lap at a time. The fiduciary, who's not actually in the car, he's not taking the risk of not having brakes, is operating as though he assumes every car starts over even again after each lap. His incentive, if you will, in terms of whatever relationship he has through bonuses or performance fees or salaries or promotions, just a job well done, starts over in his mind at the end of each measurement period. Annual returns, obviously being the most common one in the industry. And when you're optimizing that race, that long-term investment path, if you're optimizing one lap at a time, targeting average lap speed seems reasonable. If you're operating through all 40 laps, if you're optimizing back from terminal standings over 40 laps, 40 years of a savings investment cycle, it's going to tell you that convexity is the most important thing, and you should be targeting the variance of straight, the fastest parts of the track and the slowest part of the track, and optimizing your car to that, because that's what will drive the separation. And so to me, that's why so many people continue in the industry, and the industry in a great sense dominates how savers' money is managed, either explicitly through their pension fund or their wealth manager or through their advisory relationships. And everybody's grown up, gone to school, learned about the consensus. I mean, people obviously won Nobel Prizes for all this stuff. And that's the way it operates. And that's the way fiduciaries get paid, the way bankers get paid, the way hedge fund managers get paid. And so that the system as a whole continues to operate that way, which is unfortunate because it's impeding the capital growth through geometric compounding through time of the investment path of the capital owners that are the clients of that industry.
And I suppose you could see that these inefficiencies could persist through time if it's common and you're in your race, and every time there's a big curve and you crash and you look around and other people are crashing, you feel like, okay, that's just the way it is, and you just be aware. And so I guess part of it is it could be perpetual until something breaks that cycle with better knowledge and better understanding and so on, and that just takes a long time.
Yeah, and I say this all the time. The biggest flaw, if you will, in the financial industry is it simply hasn't developed a benchmark or a metric for geometric compounding, and lives on annual arithmetic returns and annual arithmetic means and resets of compensation cycles. I mean, I do a lot of work with banks and worked in banks for a long time. Nothing matters to a bank beyond this calendar year's financial statement. Everything starts over. And so quarterly accounting is far more important than long-term capital appreciation for the shareholder. And that's the way it's regulated to do. And, everything, sort of one of the ultimate evils of Sharp World, something known as value at risk, got hard-coded into the regulatory construct of the banking industry and BIS regulatory capital guidelines. And it's hard-coded in how the system works and functions. And as we discussed last time, it decides, since the fiduciary doesn't have skin in the game, he's not driving the car, let's just probabilistically measure risk, not behave the way the guy with tacit understanding and skin in the game would treat risk. He's not going to probabilistically take the risk of crashing his car. He's going to put brakes on his car. And so the system functions that way, carries on functioning that way. I always go back to the quote from Frederick Hayek's Nobel Prize lecture, where he was criticizing exactly this, where he says that, and while in the physical sciences, the investigator will be able to measure what, on the basis of prima facie theory, he thinks important. In the social sciences, often that is treated as important, which happens to be accessible to measurement. And that's Sharp World.
One of the other concepts that you mentioned last time is the pointlessness of forecasting. Yet everywhere I look, I see someone trying to predict the future and making a strong case for why they're right. And it often sounds compelling, and which I guess is why people listen. How do you think about all of this?
Yeah, I mean, obviously, people, the client, loves to hear certainty, loves to hear it. But we were talking about it today, I won't give any names, but there was an interview that was on Bloomberg TV today of a prominent forecaster giving his forecasts with absolute precision, absolute precision. And the questioner, to her credit, did say, well, at the beginning of this year, you predicted 2% return of the S&P and it's up 20 something. And he said, well, stuff happened that we couldn't have foreseen. And then goes on with absolute precision to predict next year and over the next 10 years. And I said, my guys who are watching that, my team here, I said, what a great example, right? He does not see it as his job to reflect on the accuracy of his forecasts. He sees it as his job to justify the methodology around which his forecasts were made. And if you think about, come on, we've been in the business long enough, Alex, forecasters aren't good. And more importantly, as you so precisely nailed in our conversation last time, it's not in our industry, it's not nearly enough to forecast what's going to happen. It's to adjudge the price relative to what's going to happen, is expected to happen. And as I discussed then, and again, back to my race car analogy, it's the divergences from the expectation that will drive the return path, will drive the compounding path, will drive the separation in the racetrack. It's the ability to adapt to good opportunities and avoid bad opportunities. Projecting the average literally is useless, because if you say, well, I think on average the return's going to be this much, going to be, whatever, 5%, but the variance is going to be, some years it'll be up 100%, some years it'll be down 50%. Your opportunity set is managing that variance, managing that volatility, managing that divergence. The opportunity set isn't guessing the average. It's useless.
And all of that doesn't even factor in the behavioral side, where more money goes in after the upswings and more money comes out during the downswings. So everything we're talking about is just on paper, but in practice, it's actually even worse.
Yeah. And again, this, we've all seen this. When the market's up a lot more than the forecaster and his follower said, well, stuff happened that they couldn't foresee. And when it was down much more than they thought, stuff happened that they couldn't foresee. Well, there's always stuff you couldn't foresee. The markets, the economies are so much more complex than any of the possible stacks of inputs that they could put into their hyper-flawed models to come out with some forecast. And almost all forecasts, and this particular gentleman's explicitly, was based on backward looking. Well, historically, at these kinds of valuations, future returns were this much. So that's our forecast. But, that was his forecast a year ago, and that was his forecast a year ago, and that was his forecast a year ago. Meanwhile, we've had a series, we talked about this last time, of years with 20% plus up years and 20% plus down years. The average hasn't done anybody any good. It's how you've managed your participation in the up years and your protection in the down years. And risk management, I said this last time, risk management has nothing to do with forecasting. Risk is not about predictability. Risk is about vulnerability. Risk is subjective. If a bank wants to know what its risk is, it needs to look at its own balance sheet, not at data about what's happening in some other part of the world. It's right in front of them all the time.
Last time you also threw out a lot of terms like power law, arithmetic versus geometric mean, and skew. And just in case not everybody's familiar with all of those, would you walk us through that?
Yeah. So, of course, I think most of finance is familiar with a normal distribution, or what's called a Gaussian distribution, a traditional bell curve where you have a mean and a symmetrical standard deviation, square root of the variance around that mean. And everybody can say, well, within 95 percentile, 2 standard deviations, this is what we expect. And a normal distribution is a great thing to measure simple natural phenomena, height. So if we got a group of 30 people together, we were all out for drinks and dinner, and we did a survey of the height. By the time we got to about the 10th person, we pretty much know the mean in this standard deviation. And the last 20 wouldn't change the distribution very much. And certainly the last 1 wouldn't change it hardly at all. But if we took the same survey of that same group on wealth, and the 30th person was Jeff Bezos, we would have no clue what the mean and the variance was until we asked the last guy. All right. The first 29 people surveyed, 90% plus of the sample, would tell us nothing about the moments of that distribution, about the mean and variance of that distribution. And that's a power law. So things like wealth, things like markets, things like economies, things like earthquakes, things like city sizes are all power law distributed. Obviously, the Richter scale in earthquakes is a very common one, where each step in the Richter scale means that that level is far, far less frequent than the previous one, but 10 times bigger in magnitude. Probably the most commonly well-known power law type distribution is what's known as a Pareto distribution, the good old 80-20 rule, where 80% of the wealth is 20% of the people, or 80% of the sample is captured by 20% of the components. And that's a power law distribution. And it's, the mean is very shifted, and the variance is very shifted into the wing, where that magnitude is driving the moments of the distribution far more so than the frequency. And this is exactly what we were talking about in terms of my example of the 10 best months and 10 worst months in a 40-year sample of the S&P. The magnitude of the returns in the best months and the worst months drive the return much, much, much more than the frequency in the 460 middle months. And so that's power law. There's a gazillion power laws and some interesting ones that we think about all the time, trying to better understand market behavior, market function, pricing in markets, insurance type concepts. The insurance industry is much more adept at using power laws and understanding risks and things, that natural risks and things.
In other words, the outliers.
Yeah, the outliers are so big. So like I said, Jeff Bezos is so much richer than everybody else in the room that he is the mean all by himself. And this is the problem. When something is power law distributed, the samples required to identify the mean and the variance becomes exponentially larger than if something is actually correctly normally distributed. And so, again, in that sample, height is normally distributed, and 30 people will more than tell you very accurately the mean and variance of the distribution of height. But 30 samples in the general public of wealth won't tell you anything. It won't tell you anything about the wealth distribution, because as we all know, and anybody involved in politics, et cetera, at the moment knows that all of the wealth is concentrated in the hands of 1% of the people. So until you can walk around any big city interviewing everybody, until you get to the penthouse of the largest building, you have no idea what the wealth distribution is. And that's the way markets behave and the way economies behave. And why managing your risk portfolio with an understanding of that is how you protect from those skewed. So skew being that shift in that distribution where one side is fat-tailed, the left side or the downside in return distributions relative to the other side. And the way you protect is you cut that off and try to push the skew into the other side of the distribution. That's the beneficial side in an investment process.
And would you say when we look at market data that there is just actually not that much useful data in history, meaning it's a limited data set?
Yeah, it's a very, very limited data set. The very, very limited data set. And right now, again, I think we did talk about this a bit last time. So much of what we see all the time in discussions with sell side research people, or is data sets that only cover post GFC or Greenspan era, right? Well, none of that's relevant to today. Likewise, data that goes back 100 years isn't relevant because the variables that were driving the outcomes then are very different to the variables that will be driving the outcomes now, because we've had market, economic, demographic evolution for decades. So again, the historical average really tells you nothing. The whole premise of, well, that's never happened before is not captured in the data because it's never happened before. If you run historical scenarios, it would have told you that senior tranches of mortgages had never defaulted before in early 2008. And you're just, seconds away from the whole thing defaulting and wiping out the banking system. And so the data tells you nothing about risk. So I probably said this last time, risk is about what could happen. It's the possibility distribution, not a probability distribution of what has happened. The markets, the investing isn't a casino game with odds that we know. It's not rolling a dice where you actually have known odds. So taking the historical outcomes and, the way that works, it says if you flipped a coin 4 times and it came up heads 3 times, you'd say the probability of heads is 75%. Well, we know the probability of heads is 50%. But this is the way we behave in financial markets, where there isn't a known probability in virtually any of this stuff, any of the activities. We're just taking frequency of what has occurred and extrapolating that, which is a dangerous thing to do. And it means you're forever missing out on the windfalls of positive occurrences that have never happened before. The invention of AI, and you're exposing yourself to negative occurrences that had never happened before. COVID pandemic, whatever.
It's really fascinating because if you just actually look at all the data, it's a massive amount of data. Let's say you have hundreds of years of data. So in the rest of the world, outside of the investment community, that is enough data. But the problem with the investment community is a lot of it is noise and a lot of it is environment dependent that changes. And so when you look at it through that lens, it's actually a very limited amount of data, which doesn't sound intuitive.
Which is correct, because it's, as I think we discussed a little bit, it's self-organized criticality. It's a self-organizing complex adaptive system. So it's operating on itself. So our expectation is affecting the outcome. It's Feynman's integral path. When you watch the behavior of atoms, they behave differently than when you don't watch them. I know that's kind of crazy talk. So, the system's just too complicated to, I mentioned Stephen Wolfram last time in his concept of the Rouliad. The only way to know the future is to go through the steps of getting there. And Rouliad, you think about what we have from a data perspective as our slice of time and space is so de minimis relative to the entire history of time and space in the universe, it can't possibly tell us all that is possible in the future. It just can't. But the good thing is we don't have to know. We don't have to guess what's going to happen. We simply have to construct our portfolio to efficiently provide payout functions relative to what does happen. We can play this beautiful game of insurance that we talked about last time, where the guy who insures every ship in the ocean, he actually gets the average of ships that sink. So he's willing to look at the ensemble average of ships sinking, the expected return of ships sinking, and sell insurance. Whereas each individual ship owner who's in the business of shipping, if his ship sinks, he loses 100%, not the 5% on average ships that sink. So he's happy to buy insurance at 6% per year and earn a lot more money shipping every day, so he doesn't have to be afraid about the weather or other things that he can't forecast. And this whole game, this is Adam Smith's invisible hand, is how markets work. Because as I said, everybody's risk is subjective. Everybody's in a different path. Some people are living in a non-ergodic path through time. I'm running a shipping business for 40 years. Some people can look at it as a slice of time. I'm a behemoth insurance company that can look at the ensemble average and ignore the time average. And we can all come together and do business. And the people who sell the insurance can make money, and the people who buy the insurance and run the shipping business can make money, and the people who pay the fees for the shipping business, who then construct the inputs and sell a final manufacturing product, probably put on another ship, can all make money. And this is how civilization advances and how evolution occurs. And so it's a beautiful thing. There's no reason to ignore the benefit and opportunity provided by the mechanisms of the market. Let's get out there and participate in it. Don't hide from it, sitting in treasury bills.
In our last discussion, you mentioned that investors succeed over time through compounding, and this notion of compounding, and by avoiding significant losses, which obviously can be mitigated with tail risk hedging strategies like you discussed. So last time we discussed tail risk hedging in depth, but would you elaborate on the power of compounding? I believe many investors may not fully grasp its significance and its impact.
Yeah. So again, this goes back to this sort of single slice of time versus a path through time. So if we lived in a single slice of time, we could look at arithmetic returns. And you could say, well, this year I made 50%, and then next year I lost 40%. And you add those together, take the average, and you say, well, I'm up 5%. But in a compounding path, that's not true. If I made 50% this year, if I invested $100, I made 50%, I have 150, and next year I lose 40%, I go to 90. And every step through that process on a plus 50 minus 40, which has an expected return of 5, I'm down from 100 to 90 in 2 turns, assuming it's a 50-50 game that's fair, 90 to 81 in 4 turns, 81 to 72 in 6 turns. And basically, the median of that investment path is to 0. And so the simple example that Nassim uses all the time when he talks, he's, again, if there was 100 of us in a room and we gave everybody $100 and said, go to the casino and play one hand of the same game that we know the odds of, and then come back and we'll add up the average, and we'll get out of the 100 people with one slice of time, the average. But I gave one person all the money and told him to go play the game 100 times, he'll go bankrupt every time. Because the compounding path, the non-ergodic path, again, I think I said it last time, but everybody should go and Google the word ergodicity and understand the difference between what's ergodic and what's non-ergodic. Simply put, or mathematically put, a ergodic means that the ensemble average and the time average is the same. Non-ergodic means that the ensemble average and the time average are different. So my plus 50 minus 40 coin toss through time is non-ergodic because the ensemble average, 5%, and the time average, minus 9 minus 1 over n every time is different. And so investment paths are non-ergodic, and they should be managed accordingly. And this is where the geometric compounding comes in. And this is how you grow wealth, because geometric means that you're going to multiply the returns. Arithmetic means you're going to treat the returns as additive. And when things start to multiply, you have the opportunity, the potential of exponential growth. And this is where true wealth gets built and true wealth comes from. And yet, as we mentioned earlier, the incentive structure, because it's looking at this single slice of time, tends to operate under a objective, a metric of arithmetic returns, and ignores the important factor, the single important factor, which is the geometric compounding through time.
And a simple example on the upside is you have $100 invested, you earn 10, now it's 110. You earn another 10, now you're 121. So you're up 21%, even though you earn 10 and 10.
Correct. And that's the game. And that literally is the game. So how much can I outperform in my geometric path relative to the guy who's just trying to target the average, the arithmetic average? That's literally the game.
One of the other concepts you mentioned last time in the last episode is the notion of going long or buying volatility, and that most investors are short volatility. Would you explain that a little bit further?
Yeah. Again, it comes back to convexity and again, using Nassim terminology, fragility versus anti-fragility. So something that is short volatility is fragile. So it gets hurt when volatility rises. So Nassim always uses a teacup, right? That's very fragile. If it falls, it breaks, right? Something that is positively convex, that is anti-fragile, benefits from volatility. Right? The human body, up to a certain extent, if we exercise, we get stronger. If we jump up and down, we can jump higher and higher. If we jump off something that's 10 meters high, we get hurt. If we jump off something 1 meter high 10 times, it makes us more resilient. And so long volatility positions or long convexity in your investment portfolio, again, allows you to have this acceleration in good times and deceleration in bad times. Short volatility, the traditional investment strategy, tends to be something that has decelerating upside and accelerating downside. And in the traditional sharp world type investment strategies, where we rely on historical assumptions around stable historical correlation and stable historical volatility, and we're trying to optimize to a Sharpe ratio, which we talked about last time is a Wittgenstein ruler, a terrible measure of investment performance, because the Sharpe ratio is treating upside volatility, positive compounding, as you were saying before, the geometric exponential growth rate in the downside, as the equivalent bad of the far more painful negative compounding. which is nonsense. And when you construct portfolios that are based upon, most simply put, assumptions around correlation, right? So a portfolio, you say, well, if I take these different assets and I pair them together and they have low enough correlation relative to each other, in a sense, I can take more gross risk and I get less net risk because of the correlation benefit. But what ends up happening is those low correlation partners in the portfolio aren't performing in the best markets. That's where their low correlation really shows. And so you're underperforming generally your benchmark in really, really good markets because that was unanticipated. And the low correlations, your car's driving too slow. It's driving at 60% of capacity, as we talked about in a 60-40 model, when the market's really booming. But then that same correlation starts to let you down because it picks up in bad markets. And literally, it's that bad market that is driven by the bad correlation, because this relationship where the gross risk starts to be a burden in the bad market as correlation changes that were unanticipated feed through the system, forcing risk reduction across the system of sharp world managers that are relying on that correlation. And that's why you get, again, negatively skewed market outcomes, because people, what they thought was risk reducing in their historical analysis and assumptions around future expected returns risks, which they measure as volatility and correlation, turns out to be wrong, and they all need to de-risk at the same time. So you're in this perpetual problem of underperforming, relatively speaking, in good markets and underperforming, relatively speaking, in bad markets. And your peak performance relative to your objective is in those very rare occasions where it comes in around the expected mean. Now, of course, as we discussed last year, things that are bought and priced and invested in and constructed around achieving the expected outcome tend to have relatively mediocre returns. And that, as we learned, tends to not drive the compounding. What tends to drive the long-term compounding is the big numbers that are away from the mean. And that's where the traditional investment structure tends to perform, relatively speaking, the weakest, because those correlation assumptions are a burden in good times and a burden in bad times. And so that's why you want to switch and add convection, add explicit negative correlation, allowing you to take more of the stuff that has the participation in the upside, that opens you up to more of the upside, so you can harvest more of the good when the sun's shining, knowing that you've got the protection in the inevitable through this path. Again, you might say the 1 percentile outcomes are very unlikely next year, but in everybody's own investment path, I guarantee they get their 1 percentile outcome. They must, right?
So going back to the race car analogy, where there's a windy road and the common strategy is drive only 60% speed, which, as you, I think, very thoughtfully pointed out, when you do that, it's inefficient because you're going too slow during the good times and you're going too fast during the curves. And so you're likely to crash and underperform over time. So what about this other way of thinking about it, where you have a super diversified portfolio? So a 60-40 portfolio is not that well diversified. Basically, all your risk is in the stock market, which is a very volatile market. What if you, instead of that road, you travel on a road that maybe isn't as curvy because you have a much more diversified portfolio? Maybe you're invested across various markets. You're invested across managers who have a track record of being low correlated to traditional markets, even during periods of stress. Maybe you have other components of your portfolio, maybe private investments where there's less efficiency, more alpha potential, and you put all that together. And one way to conceptualize that is the road you're traveling on is less windy than the road where the portfolio is less diversified. So on a road like that, is there less need for good breaks, or do you think about it differently?
Because even in that portfolio, while let's argue you've done a better job of diversifying than a less well-diversified portfolio, that portfolio is still relying on assumptions about correlation. assumptions about historical correlation, historical behavior between asset classes, or how managers have behaved in other past times. If there's nobody in there that is explicitly asymmetrically negatively correlated, you're still going to run into the same problem. You may not crash, but you're going to still have this concave performance dynamic, this volatility drag on your portfolio. You're still going to benefit in that portfolio by adding explicit, asymmetric, negatively correlating protection and replacing some of your other diversifiers that are, sharp ratio maximizers, where they're not capturing upside and not providing nearly as much downside protection. Right? So the benefit of that asymmetry to allow you to participate, to just eke ever more capital into your goal scorers, your accelerators, is going to make a difference, because that's going to still better capture the upside downside magnitude of the largest divergences, and that's going to improve your compounding path. So yes, the more effectively you diversify, the less risk you have. But even then, that diversification, to the extent it's relying on historical correlations or assumptions about historical behavior, you still need something that cuts the tail, and you need to fund that by taking money away from what I would call defensive midfielders, right? Guys that play really well in the middle of the field, but not so well in the goal scoring boxes, and get more goal scorers on and a better goalkeeper on. It's still going to make a difference.
So last time you talked about your approach of seeking cheaper insurance by focusing on the second or third order impact from periods of crisis. So this introduces a concept we didn't talk about last time, which is basis risk with indirect hedges, as opposed to paying more for direct hedges. Would you talk about how you think about that risk?
Yeah. So, a lot of people will be concerned because investors, investment managers, wealth managers, tend to measure their risk in a certain given way. So they might, as I think I may have said last time, they might measure their risk as, we think our risk is S&P beta. Now, even though they're running a global multi-asset portfolio, they've simplified their risk measure down to S&P beta. And I will tell them all the time, your risk is correlation. The whole assumption you're making to measure your S&P beta is an assumption around the historical correlation of all the components of your portfolio to the S&P. And it's that assumption that's going to be the problem, not whether the S&P goes up and down in a, as you were describing, a well-diversified portfolio.
Because the portfolio becomes less diversified when you need the diversification the most.
Correct. The assumption you're making to say that this, whatever, $10 billion portfolio has $5 billion of S&P beta. Guess what? It's going to have more than that exactly when it matters, because the correlation you were relying on to reduce the gross risk of $10 billion down to your measure of net risk is an assumption about correlation. So we tell everybody your risk is correlation. And if you went and looked at the performance of most any market in any significant drawdown, that drawdown aligned with some sort of correlation event the world over, as we were discussing earlier. It's when that correlation changes that undercapitalized risks get forced to be liquidated. And that's literally what creates the skewed return dynamic of markets. And as we discussed last time, that's heavily driven by the use of leverage. And in a sense, diversification is a leverage tool, right? If I say, I've got enough capital to run 5 billion net risk, but I can create that 5 billion net risk through diversification and run 10 billion gross. That's effectively the measure of your risk is de facto leverage. And when it proves wrong and correlation overshoots your assumptions, now you've got to be liquidating. And it's the fact that that's happening throughout the market that causes it. So many people are concerned because they want to match the risk they measure as opposed to match the risk they have. And so that basis risk you're talking about is they might come and look at us and say, our risk is S&P beta or emerging markets or whatever they want to define as the risk. We need to hedge that. And we're saying, your big risk, your systemic risk is correlation. Now, there's every logic to go and hedge idiosyncratic or what we might call systematic risk, and you might want to, buy puts on your actual S&P risk or buy CDS protection on your emerging market bond portfolio. But your systemic risk, where something happens that you think is unrelated to you and it spreads throughout the whole forest, is best hedged by the things that are most exposed to the spreading of the fire. And you do that by finding the most attractive price, because that price, as you said earlier, inversely relates to the amount of risk. And you'll find that over time, things seemingly unrelated to the event had much bigger payoffs in the correlated shock. And trying to get people to understand, because people, the biggest of institutions don't want to measure their correlation risk, because their whole premise of their sharp world modern portfolio theory, portfolio construction methodology is an assumption around stable correlation. And so if you start measuring correlation risk, people's eyes can get opened that, so again, you can imagine 60-40 portfolios that made assumptions about the historical correlation benefit of those bonds. Their mismeasurement of that risk in 2022 meant that their losses were much larger than their risk measures had said they could be, which then inevitably contributed to the joint bond and equity sell-off as people needed to de-risk because they were taking more risk than their risk methodology claimed, and that nature of that risk was a change in the correlation that they assumed would stay constant in their risk methodology.
And so if the true risk is that your main assumption that correlations are stable through time diverges and correlations go up right when you need that diversification, then in terms of portfolio construction, you can go out and buy hedges or insurance against that risk. And you can find it cheaply, because when it's the cheapest is probably when it's the most valuable.
Correct. What we do, and it's hard to do, is all day, every day, all we do is track volatility supply and work with our counterparties trying to find attractively priced, efficient, ever longer duration convexity. Any market, any asset class, anywhere. And it's very difficult for somebody to do that. It's not a full-time job. The complexity of some of the products in the markets make it difficult. The inversion of the credit relationship with the counterparties, where you're doing it in bilateral OTC markets, require a credit construct that most people don't have in place. The efficiency of doing it on easy to access exchange traded markets, we discussed last time, makes VIX generally egregiously expensive and so somewhat ineffective. Now, having said that, there's a number of my friends and competitors that are in the tail risk or long volatility business that use S&P and VIX because it's a very efficient market, but they need to find ways to cope with the cost inefficiency in that. So they tend to be much more active trading. They tend to use algorithms. They might use RV strategies. It's just egregiously expensive. My advice, to the extent it's possible for anyone who's listening, is find any and every reputable tail risk long vol guy you can find and start talking to him, start building a relationship with him. Because the beauty is there's no constraints in how many goalkeepers you can have on your team. And just like investing, just like you diversify your investments, exactly to your previous question about basis risk, the spread of that fire is very path dependent. And there's going to be events and occurrences where one style of tail risk strategy would definitely be more effective than another style. But in another occurrence, the other style will be more effective. So pairing tail risk or long vol type managers together that go about it in different ways is a very, very good strategy. And obviously the bigger institutions all do that, which is why we all know each other, because we end up working together on stuff. And while we're out around the world doing things multi-asset class and OTC markets, we work all the time with people that are doing things in S&P and VIX, or guys that are specifically doing things in Europe, et cetera. And are in interest rates exclusively, or And so, but just the conversation, getting out and talking to, your clients, talking to you so that they know you're talking to me and other people that do this, so that everybody's starting to get an idea of how to construct a portfolio that benefits from the divergences from the expectation, that benefits from better positive correlation in good times and better negative correlation in bad times. Not an assumption around steady correlation that gives you the exact opposite, where you've got too little correlation in good times and too much correlation in bad times, which I'm sure you've seen over your careers.
I recall the first question I asked you in the last episode is this idea that the vast majority of investors, at least in my experience, focus on returns. Returns are things you can see. Yet so little attention is paid to risk. Risk is harder to see. It's harder to understand. The concepts are more difficult to grasp. And what I'm hearing you say is try to think about that more. And the more you think about it, the more you recognize the impact it has on your portfolio and ways to mitigate it, the better off you are over time.
Yeah. And again, history is a terrible measure because history only tells you what did happen. So I always use the simple example, two guys climbing up a cliff face. One guy has a rope, the other guy doesn't. They both, in a perfect sunny day, dry rocks, no wind, they both climb up at the same time and get to the top at the same time. And if you measured it, did they have the same risk? When the financial markets, they'd say they did have the same risk. But the guy with the rope had far less risk the whole time. And the next time they're climbing and it starts raining or the wind blows, the guy with the rope's got an enormous benefit because the other guy's now like, I'm not climbing today. Back to my shipping example. The guy with insurance is shipping every day, no matter how bad the weather is. And so he's getting the highest fees because the guys who said, I don't need insurance, I'll just hire a good economist to forecast the weather for me. He's sitting in the dock half the time because the guy said, well, I think the weather's going to be bad. And so this understanding of what could have been and the opportunity it gives you by having that rope to climb every day, no matter what the weather conditions are, not fall off the thing because of a surprise gust of wind. And in theory, maybe climb faster because you got a rope than the guy who needs to be a little bit more cautious because he doesn't got one. And to simply measure them on the one day when they both climbed the same speed and said, well, same risk is wrong.
Yeah, and it's hard to see. The example that you just described is easy to see because we know how much safer it is to climb with a rope than without a rope. But in the markets, it's not as obvious. And so you could have two strategies that travel through time and they have the same return and one took half the risk. You don't see the risk unless something bad happened. And I think a simple way to conceptualize that is I always go back to the roulette wheel. Let's say there's 100 spaces and you have two wheels and one of them has 90 winning spaces and the other one has 10 winning spaces and 90 losing spaces. And you have full visibility and you only get one spin. Which one do you want to spin? You want to spin the one that has a 90% odds of success. Yet you could actually spin those and you only get one turn. And the one with the 10% odds of winning wins. And the one with the 90% odds of winning, let's say, loses. You could look at that and say the 10% one was the better wheel.
Yeah.
Right. And obviously it was not.
And that comes back to numerator, right? So easy to measure the numerator. That's what happened. But the denominator, people didn't know the difference between the wheels. They don't know.
That's
they
right.
Just say, well, that won, so I'd rather go play that wheel, which is nonsense. And it's the same thing. And this is why, volatility is a risk measure. Sharpe ratio is terrible, terrible risk measure because it's exactly what's exposing you to that. A far better risk measure is downside volatility or drawdown, negative beta. What was your beta in negative markets? Something that shows, that lets your eyeball start to see, is there superior convexity in that strategy versus this strategy? And very few people take the time to look through and look at that because, as you say, we talked about last time, they forgot that you need to equalize the denominator before you compare the numerators. And by race cars, at the end of the race, we all know the guy with the best brakes won. How do you attribute the value of the brakes? You don't. You just say, how fast did he drove? But the reason he did that is because he had the brakes.
And it seems like a lot of this misunderstanding can persist for several reasons. So this is kind of summarizing a lot of what we talked about. Number one, you have a limited data set. And most people don't realize that it's limited because they see a lot of data. So that's issue number one. Number two, there's an effort to try to make a science out of this, and it's not scientific. Not only do you have limited data, but there's a lot of variables that are just difficult to predict. Number three, you have this notion of alternate histories, all the things that could have easily happened but didn't. And you only see what actually happened, not all the things that could have easily happened that did not happen. And so you put all that together and you could see how we could continue on the path of this conventional view of risk and how to manage portfolios, even though it's obviously faulty.
Yeah. I mean, I make fun of is, having read some of my stuff, sometimes I poke a little bit of fun at central bankers. And both Hugh Pill, the chief economist at the Bank of England, and his boss, the governor, Andrew Bailey, have both made comments going back to the period of transitory inflation or high inflation and said, well, our models just didn't work. And turns out our linear models, when we moved away from our target and it became nonlinear, our models didn't work. They're not changing the models. They're just saying, well, when it moves, our model doesn't work. And that's a great example of sharp world, right? That distribution for the longest time looks normal. But in reality, the whole time it was a power law distribution. And you'll only find out when you get that data point, right? You'll only find out, oh, shit, he didn't have brakes, right? When you get the data point. And so, when you're interviewing managers, when you're talking to the guy who manages your pension, your wealth, or whatever, these are the questions you need to be asking him. You need to be asking explicitly about the convexity of his portfolio. What is he doing to put positive convexity into the portfolio? Is he relying on historical correlations? Is he relying on things that are low correlation because they were low correlation during all the good periods? Only to find out, I'm sure you've heard it a million times, yes, we didn't keep up with the market, but look how low our risk was, and so we were being prudent. And so, yes, our returns are bad are underperforming a good market, but our Sharpe ratio is good because our conservatism is showing through. And then when they underperform on the downside, they say, well, yeah, but that was an event that we couldn't have seen coming. Well, all the while, they didn't see either side coming. As we talked about last time, they didn't see 2022 being bad and that correlation breaking down, and they didn't see 2023 and tech stock and NASDAQ going to the moon. Both times they missed it, and both times they had bad convexity in their portfolio because they were relying on faux linear normal distribution, simple assumptions around steady correlation and ensemble averages.
And also in practice, as a practitioner, I'm looking at strategies and managers and return streams all day for a couple decades. And one thing that is very obvious is there's a massive survivor bias, meaning we automatically exclude all the things that had a big drawdown in the past. A lot of them go out of business. And so what's left are the ones where the risk hasn't surfaced yet.
Yeah.
And so our analysis is all about not how have you done in the past, but what's the risk that's going to get you in the future? And can I understand that? And do you understand it? And how are you positioned for it? And it kind of goes back to your convexity thought.
And exactly, what you said last time, the danger that's always the case. You think about what people, again, traditionally invest in, include in the portfolio as diversifiers. What in my soccer analogy I refer to as defensive midfielders, right? When you go out and hire an absolute return hedge fund, you're probably hiring him as a diversifier against your otherwise equity, beta, growth assets, real estate, private equity, public equity, right? So you're hiring him to play defense, but you're incentivizing him to score goals. You've put him on a goal-scoring metric, but you've hired him to play defense. Now, he probably comes in, and for the first few games, he's playing a defensive midfielder. But over time, as his performance suffers, he starts playing forward a little more. Or your example that you gave last time, as he gets further and further down the straightaway, he decides it's okay to drive a little faster. And so just as he gets the most leaning towards the offensive end of the pitch, despite being hired to be a defensive midfielder, is when the ball gets booted the other way and he's not playing defense. And so you see this all the time. You see the underperformance during the long bull market of supposed low correlating defensive absolute return strategies, whose beta inches ever higher and higher. Their correlation to the market inches higher and higher, and is inevitably at its highest just as the market turns. And then they end up not being, and the ones who don't survive, as you say, drop out. And the ones that get evaluated, as the guy that was driving 60% of speed crashed, but the guy who was driving 55% of speed survived. But he's still got the same problem. And the next unforeseeable, not yet occurred curve is going to get him. And so, the questions that people need to be asking is about convexity, about tail risk, about protection, not relying on historical correlations, not making assumptions about stable correlations. The risk in your book is the correlation assumption. It's the fact that correlation will consistently underperform in good markets, underperform in bad markets. It's not stable.
One notion you've alluded to a couple times is this idea of the Fed put. In other words, when there's a massive curve that is going to cause a lot of crashes, the Fed will step in to save the day, and they'll provide stimulus, and they'll do whatever it takes. So what some believe, and please tell me if this is accurate or not, but what some believe is that I already get free breaks because the Fed is there in case something really bad happens that causes systemic risk. How do you think about that?
Yeah, and this is exactly what happened. The Fed regulates everybody into sharp world practices, in particular the banks. And then when they're all crashing, they've got to come in and save the day. Otherwise, the system goes away. But each time they do this, they're building more fire risk for the future. They create the moral hazard. They create the bad risk management. People say, well, I don't need to worry about it. I don't need to worry about fires because the Fed's always there to put them out. Well, then the next fire starts and spreads a different direction than the one that they decided to protect you from, and you get caught in it. Plenty of people got caught in 2008. Plenty of people got caught in 2020. Plenty of people got caught in 2022. Yes, the Fed comes in and saves the system. The system itself has its own sort of natural resilience. Strong capital hands come in and soak up cheap assets that have been forced out of levered, weak capital hands. The system's naturally resilient. But certainly the Fed jumps in and helps when the banking system's falling over and risks a societal pull down. But each time they do that, it makes the system more risky through time. Like Yellowstone Park, the more you put fires out, the more risk you get. So the more you have to put fires out. So that you think about what the Fed's doing or central banks are doing, they're always fixing the problem that was created by the problem they fixed when they were fixing the problem that was created by the problem they fixed. And it builds and builds and builds. And that just creates this, inevitable self-organized criticality sandpile thing. The sandpile builds up and it collapses, and it builds up and it collapses. And it's the history of life in the world. It's the punctuated equilibrium of evolution that is not the way Darwin drew it up of a nice stable evolution. Evolution does very little and then jumps, and then does very little and then jumps, right? Again, it all comes back to complex systems. Self-organized criticality. Everybody should go read. One of the best books you'll ever read as an investor is a book by a physicist by the name of Per Bak, Perbak, called How Nature Works. And it's about how nature works. It's self-organized criticality, sort of that specific part of chaos theory in physics that talks about sand piles and avalanches and forests and evolution and volcanoes and all the stuff that has this power law, self-similarity, self-organized risk that then disseminates to find restored stable equilibriums. And that's exactly how markets work.
One of the ideas you mentioned last time is the Fed's primary goal is financial stability. So obviously their mandate is reasonable growth, reasonable inflation, but the primary objective is to maintain financial stability. So if every time there is, a crash on the road, they come in and they provide stimulus to try to allow the system to survive. How do you reconcile that with the notion that you just described, which is every time you do that, the system actually becomes more fragile, and at some point you could have a major accident that is not easily recoverable from?
Yeah. 2008 is a decent example. The Asian crisis is a better example, where you had countries that really went through a cleanse. 25% GDP contractions, years of 25% unemployment, 80-90% currency devaluation. That's a scale unlike anything you saw in GFC. But the GFC, pretty severe, and investors' compounding path took a major hit in that process. With good breaks, you cut off a significant amount of that major hit and get to participate in the recoveries much more aggressively. Same with 2020, same with 2022. So the fact that the Fed at a certain point, hopefully, or the central banks, governments are going to come in and bail it out, hopefully, doesn't negate the fact that you had a 50% drawdown. And if you can cut off that 50% drawdown, back to my S&P 480 month path, 10 worse months contribute 40% of that 40-year compounding path. You cut off those 10 worst months, you will structurally change your terminal outcomes massively. And you'll get to participate, if you're doing it right, you're participating more in the 10 best months. All right, so you've just driven the contribution of how you've constructed your portfolio to the parts that contribute the most. And so there's no point ignoring the drawdown because you say, well, the Fed won't let the world come to an end. I'll just ride it out. Why not take advantage of it? Why not benefit from it? It's the, consistently the most attractively priced opportunity out there, because the fact that that happened probably is because it's priced like it couldn't happen. And it happened because the reason, again, you had that extreme left skew tail event is because there was a whole bunch of leverage build up around the belief in the moral hazard that they wouldn't let that happen. I guarantee you, because I talked to a lot of them, none of the central bankers wanted to let all the banks go. None of them wanted to have to bail out every major bank in the world. They didn't do it on purpose. None of the Asian central banks wanted their currencies to devalue 80%. They were swearing up and down they'll do everything they can have to do to prevent it. Yet it happened. And so I don't know what the next peak and bubble and correction and redistribution is going to be, but I do know it will be. The world's not going to somehow magically, for the first time in all of history, embark on a straight line 7.5% annual gain of investments for the next 100 years. It ain't happening. The variance will matter a lot more than the mean. And you construct your portfolio optimized to the variance, optimized to the geometric compounding, and it will tell you own the convexity. All right? If you optimize your portfolio to annual returns, one slice at a time, short-term probabilistic, it'll say, sell convexity. But then you're destroying value in the divergences.
Something that you just said strikes me as really interesting, and that in 2008, 2009, the market fell 50%, yet the Fed put was still obviously in force. During COVID, the market fell a third in 5 weeks, yet the Fed put was still there. And so you've had these major drawdowns, and you mentioned other countries, major drawdowns where the central banks stepped in and did whatever it took to allow the recovery. It's also possible that they can't protect you during the worst of times. So you've had these massive drawdowns, even with that protection, with that hedge. We shouldn't assume that that's always the case. The next crisis, they may not have the credibility or the tools or the ability to engineer a rebound. So that's another reason to try to protect against that tail.
Yeah, absolutely. But again, the main reason to protect against that tail is so you can participate more in the good times. That's the reason to have better brakes isn't because you're afraid of crashing. It's because you want to drive faster. Right? So many people miss this perspective, right? I'm not telling people to be more cautious. People are already too cautious because they're driving around without brakes, right? They're, as we said last time, they're just suckers for the bearish siren song that is just constantly pervading the the airwaves, and they're always cautious, and their financial fiduciary is cautious, and he's being prudent, and he's optimizing to a Sharpe ratio where he's forever foregoing upside to reduce downside. It's the wrong mindset. It's the wrong way to do it. And so, the point isn't that I think the world's coming to an end or that there's going to be some phenomenal crash. There will be crashes. I think everybody pretty much accepts that. The point is, in between the crashes, there's enormous opportunities. Coming out of the sharp curve is the best time to go fast. But everybody's backward-looking risk methodology, exactly as we discussed last time, is telling you after that really scary curve, we better go slowly. And then eventually you said, geez, we've been driving on the straightaway for 3 miles now. Let's start going faster. Right? So you end up always with you get it wrong, right? You're buying high, selling low. And that's exactly the behavior, again, that creates this dynamic, right? Too much risk builds up because it now looks good, so I can add leverage to it, right? I can expand my gross in my portfolio, a multi-asset portfolio benefiting from what's been really good correlation for the last bit of this straightaway. I can gross it up relative to my risk appetite, only to find out I did that exactly the wrong time, and now I got to gross it down because all of a sudden correlation changed on me and we hit a curve I hadn't foreseen. And that's why markets behave the way markets do.
An interesting way to look at what you just described is if you're the driver in that car, it's very understandable that after a sharp turn, you're going to be more cautious and drive slower. And after driving for an extended period on a straightaway, you're going to feel more optimistic that the future will look like that and you'll drive faster. Yet if you're sitting in the tower 100 feet up and you look down and you're looking at the big picture, you could see what a mistake it is to behave that way. But it's understandable for the person doing the driving.
Especially if he's driving without brakes.
Right.
Right. But if he's driving with brakes and he understands that, he's hitting the accelerator as soon as he comes out the other side of that curve. He knows it, right? He knows, right. I got brakes. I'm ready to go. He's constantly looking for the opportunity to go, knowing that he's got brakes if he's got to back it off, right? Whereas the other guy's trying to adjust his speed just by pushing on the gas or releasing the gas, pushing on the gas or releasing the gas. Well, inevitably, he's going to screw it up. He can't react fast enough. And it's that, again, this is the guy driving that way is exposing himself to the volatility drag, this compounding volatility drag where negative compounds pull you further back than the positive compounds recover you, versus the guy who's got the convexity, who's benefiting from the divergences. He's immediately picking up speed in the good parts and immediately decelerating in the bad parts, not the other way around. And that will change your compounding path just unbelievably and magically. Like I said to you last time, it's very hard to find the point where you made the right call. You just kind of always are right. You're always benefiting.
So you've explained the concept of insurance as it relates to investments as not being zero sum. And it's because you have to add in the fact that the buyer of the insurance can take more risk. Now, outside of that, if we just look at the insurance itself, does the insurance itself have a negative expected return over the long run?
No, absolutely not. Right. Again, depends on price. It depends on unknown future outcomes. But the insurance, again, it's like deposits in a bank. Deposits are a negative carry, but paired with loans, it's a very profitable business. It's non-recourse leverage against higher priced recourse leverage in a bank. And they keep all the difference. And if they screw up their lending, they don't have to pay back the depositor. Somebody else will. So again, buying insurance is the same concept. Now, you don't buy insurance. You wouldn't, again, it comes down to this difference. Who's on a ergodic view, the insurer who insures every ship in the sea, versus the guy who's in the non-ergodic path. He has one ship and he's in the shipping business. Well, it behooves him to buy insurance and make more money delivering every day, regardless of the weather. You wouldn't bet against the insurance company. You wouldn't say, well, I'm going to take the other side of the insurance company's view as a bet that I think there's going to be more than 5% ships that sink this year. Now, people do that in the markets. That's a trading activity. Traders might make that bet because they say, oh, everybody's forecasting good weather this week, and I think it's going to be bad. And a few of these ships are going to go out and sink more than the cost of the insurance. So I'll take a bet that more ships sink because I have some different view of the weather. That's a trading activity. That's not an investment activity. That's not a shipping activity.
And that's zero sum. So there's a winner and a loser.
Yeah, in a bet, there's a winner and a loser. In an insurance activity, there's two winners. In a deposit, de minimis, but the depositor makes money. But so does the bank. Right? Now, sometimes the bank's relation, because the bank's in the business of intermediation, so his relationship is between the non-recourse leverage of the deposit and the risk he's taking in lending that out. And he doesn't care in any given year which side the profit comes from. So in most years, the profit looks like it's coming from the loan. In some years, 2022, it might look like it's coming from the deposit because interest rates went up so much. So he made the profits from the liability side. But he doesn't care which side it comes from because what he cares about is the relationship. Same as my shipping guy. He doesn't care which side he makes money on, as long as when he's shipping, he makes more money than the cost of the insurance. And when his boat ships, the insurance makes all the money and covers the cost. He also bought, business interference insurance, right? And so it's the relationship between the two in this insurance activity, which is very different to a betting or gambling or trading activity, different activities. And remember, a guy selling puts and a guy buying puts are taking, in a bet, in a trading, are taking different views of the market. But a guy buying insurance, the guy selling insurance and the guy buying insurance are taking the same view of the market. Just one providing non-recourse leverage against that view and one taking the non-recourse leverage to take that risk.
And I suppose a very simple way to understand why both sides win is you just have to look and see there's a massive insurance industry that has been around for decades, generations.
Yep.
There's life insurance, there's health insurance, there's all sorts of insurance, property casualty insurance, and those, both sides do well in that, and it's been around forever.
Yep. There's a shipping industry, right? There's a banking industry. There's an investment industry. Trust me, all of this vol selling that's getting done in the world, the people taking the other side of it aren't going out of business. Somehow, some way, right? Banks aren't going out of business taking deposits, despite paying for them, because they're using that as insurance, non-recourse leverage to go out and take other risks. That's the way the financial markets work, and I'm fairly confident that end of the day, the guys using this supply of optionality, of volatility to manage better their risk are doing just fine, doing really, really fine relative to the guy who's selling it.
Dave, you've been super generous with your time, not just on this episode, but the previous episode. And I know it's late at night in Singapore where you're located. So I have one final question to ask you.
Fire.
So let's for a second talk about implementation. So how would investors implement your strategy at a high level? Is it as simple as they have whatever the portfolio looks like, it's a diversified portfolio, and they can add a tail risk fund or a strategy that acts like insurance, where its return behavior may be, small, low positive or low negative returns for a while, and then you get a big positive return when you need it most. Is that conceptually how it works?
Yeah. So the concept is, so one, you would never look at your insurance on a standalone basis. So looking at a tail risk strategy on a standalone basis is meaningless. And like I said, it's like looking at your insurance and say, well, it costs this much every year.
And there was no fire.
Yeah, there was no fire. There was no, without even asking how much insurance did I own. Right? You just look at the cost. It's meaningless. You've got it. So the whole point of this is to free up capital. So most portfolios have too much capital tied up in faux defensive strategies and assumptions around correlation. Obviously, most prevalent is bonds. So the whole world has for decades invested in 60-40, some sort of assumption around equity bond correlation, which has been a disaster. The bonds have been an enormous, enormous opportunity cost to that portfolio, right? You would have been way better owning explicit protection and putting more of that money into equities. You would have had something that protected much better in the bad times, and you would have had a lot more money participating in the good times. So the whole point is to free capital that is in inefficient, ineffective diversifiers and get more money participating because you can more efficiently protect with something that's far more explicit. And that combination, even when bonds were good, outperforms. Right? And the other thing, one of my other pet peeves, and I'm sure you've thought about this before too, is the one thing that nobody measures is opportunity cost. Right? Nobody measures what I missed out on. Everybody says, well, my bonds didn't really cost me any money. You had 40% in bonds that have, flatlined for 13 years now, in a real basis, are down in a market where equities have tripled. The opportunity cost of that, everybody ignores because nobody wants to admit to it. Nobody wants to go and tell the trustee or the investors group, yeah, we screwed up. We should have made this much money because we could have put brakes on the car and put more money at work. So the whole point, I'm not trying to reduce people's exposure to growth assets, to unbounded potential upside. I'm trying to help them increase it. I'm trying to reduce their exposure to bad diversifiers, bonds, absolute return, Sharpe ratio optimized, low vol strategies that neither participate nor protect. Your portfolio, everything should be judged. Does it participate? Does it protect? You start pairing those together, negatively correlated stuff, and there's this magic thing. You can tell your viewers can go and Google Parendo's paradox or Shannon's demon. There's this magic thing where you pair things together that negatively correlate. Shannon's demon shows you, even if they both have a negative expected return and they negatively correlate and you rebalance them, it's profitable. Right? And that's a little bit of this magic dust of the convexity in the thing. And so that's really where you're focused. Now, obviously, people need to make decisions about pools of liquidity. If you're an endowment, you've got money that you got to pay out, or if you're a pension and you've got mismatches in inflows and outflows, et cetera. There's a liquidity requirement in things. But that, in my opinion, that's not part of your investment portfolio. The part of your investment portfolio that's targeted at terminal compounded capital for somebody's retirement, for the next generation of the family, for the university 25, 35, 45 years down the road, needs to be focused on what participates and what protects. And that's where you really need to, and you're not going to do it overnight. You're not going to take a traditional modern portfolio theory, Sharpe world portfolio and revolutionize it overnight. But every chance you get, you can be reallocating what I call dead capital that's in these ineffective diversifiers and putting some of it into explicit protection and some of it into explicit participation, whether that's equities or real estate or high yield credit, stuff that participates, knowing that during the good periods of correlation and participation, that stuff does great. And in the bad periods, it's the correlation risk that your hedge needs to kick in and provide the deceleration for you.
I think you alluded to it just now, and it's really important because you're buying this hedge. So let's say it's a fund that provides that hedge. And if you look at it on a standalone basis, you may be disappointed, but you have to think of it in an aggregate basis. You have to look at the whole portfolio and look at it through time. And in reality, you're buying this insurance, you're buying this hedge and hoping it does poorly, right? Because that means the rest of your portfolio is doing great. And so if it actually does poorly, you should look at it and say, oh, that was a waste. You want it to do poorly.
You want it to do poorly, right? You got to recognize it's allowing you to take extra risk. It's allowing you to drive more confidently, more aggressively, right? That's the whole point. The whole point of brakes is so you could drive faster. You don't put brakes on your car. You don't take your 60-40 car, your 60% car, and add brakes and still drive at 60%. No logic to that, right? The whole point is to let you be more confident, more aggressive in how you pursue the participating risk. That's the point. Nobody would evaluate JP Morgan separately between the cost of their deposits and the return of their assets. Nobody's going to kick out all the depositors and say that's a shitty business. It loses us money almost every year, right? It's mindless. And exactly as you say, and this is exactly how we operate. We hope our investors never need us, right? We hope that their compounding assets and participating assets just grow and grow and grow and grow forever. And we'll spend our days all day, every day trying to increase and increase and increase the potential asymmetry in insurance that we have if they ever need us. And we high five ourselves every day, month, year that they have a great year. All we focus on is their returns. It's not our job to focus on our returns. There's no point us focusing on returns. Everything we're buying because it's priced like nobody thinks it could ever happen. We're not buying it because we think it's going to happen. We're not making a bet, to your example of a zero-sum bet in insurance. We're buying insurance so that they can take risk. We're focused on the relationship between the insurance and the shipping business. We're not focused on a bet that we're trying to make with somebody who's providing the insurance. And that's the mindset that a good tail risk manager has to have. If a tail risk manager is trying to optimize his performance, optimize his compensation, he's lost the plot. That shouldn't be his job. You don't hire a goalkeeper and then incentivize him with goal scoring metrics.
Well, Dave, this has been a fascinating two-part discussion. I appreciate you sharing all your insights. I've already heard great feedback about episode 1. I assume the same for episode 2. So thank you so much.
Thank you, Alex. A lot of fun and really, again, just like last time, so well prepared. And it's fun to have the sort of come back again and elaborate on that. So I appreciate you making the time for it.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed.